Big inflation data just out, and consumer sentiment plunges, now lower than the height of the 2008 Great Financial Crisis. Personal income and spending surge, however, coming in much higher than expected. What's going on with the chaos of economic data? What's really going on in the US economy, and why does none of it make sense? So, this has been a very, very common refrain in the comment section. We're going to go focus the meat of the video on that question, on addressing the question: how does the data keep coming in so strong, and yet the average person is doing so poorly? So we're going to take a look at that. That'll be the meat of the video. Look at consumer sentiment, which is now lower than the height of the 2008 Great Financial Crisis. But yet, as we'll see, some of the data points continue to come in strong. So PCE, this is personal consumption expenditure, month over month, came in right in line with expectation. The 3-month moving average is running at about 0.3% on average month over month rate of change for this measure of inflation. Personal income came in hotter than expected, 0.4%. The expectation was 0.3%. And of course, the 3-month moving average running at about 0.4% month over month growth for personal income. We'll take a look at why that's not actually nearly as good for the average American as the data would suggest. So personal spending, this also came in hot, 0.6%. The expectation was 0.5%, and the moving average is running at about half of 1% month over month growth for personal spending. Now, remember, yesterday's GDP print that did come in very, very hot. Personal spending, or as they say, personal consumption expenditure, PCE, this did grow significantly from quarter 1 into quarter 2. That was a large driver, of course. A reversal of net exports that was a large driver. Now, if you would like to read through the report, I will link this in the description, but we're going to keep moving here. So annual PCE on a year-over-year basis came in again at 2.75%. Core PCE came in at 2.9%. So again, inflation is running at basically 3%, not 2%. In blue here, we have the Fed's long run average or target that they try to target for this 2% inflation. We can see going back to 2000, they were generally successful, except for this period of time going into the Great Financial Crisis and the GFC, where you did have slightly elevated inflation. They have been generally able to keep inflation moderate. However, they're apparently failing at that mission. They keep cutting rates. They not only cut last September when inflation was elevated back then as well in October, but they cut again this past meeting, and they are going to continue to cut. Another 2 cuts are expected. Now, moving to University of Michigan consumer sentiment, this has not updated, but I wanted to show kind of a long-term time frame for this. This came in at 55.1. So as you can see, that is lower than the low that consumer sentiment hit in the height of the 2008 Great Financial Crisis. So here we can see the final results for the University of Michigan consumer sentiment. I will link this in the description. We can see for September, this dropped notably from August, 55.1 from 58.2. Summary of current economic conditions also dropped from 61.7 to 60.4. And the index of consumer expectations for the future, this also dropped significantly from 55.9 down to 51.7. Now, here is the chart showing consumer sentiment. Now, this came in, again, the height of the GFC was actually slightly higher than the print that we got for sentiment today. And as you can see, we have never been at these levels without a recession. So if you go back to 1973, there was a recession. 1980 and 81, there were recessions. And then, of course, 2008 GFC, there was a recession. Well, this time we have very, very low consumer sentiment, and we also have very, very low readings in the current economic conditions index, but yet no recession. So what is going on, and why does the data feel like it's lying? A lot of people have been putting that comment, well, you can't trust the data. The problem is not the data is fraudulent. The problem is how these metrics work. So here we're going to look at personal income and personal income per capita. And as we can see, total personal income, $26.28 trillion. Now, if you look at per capita, that is 153,000, and again, that is per person. Personal income per person. We can see that is 153,000. Well, this is how the data is presented. And if you look at it just this way, it looks like, yeah, everything is great. However, you can't look at it that way. You have to, for example, divide by the M2 money supply. What good is an increase of, say, 5% in personal income over a year if the money supply grew by 10%? So you have to use the right denominators. Once you do that, you can see that personal income as a share of M2 has fallen from 181% share of M2 money supply down to 118%. So again, in real purchasing power terms, over the past 25 years, personal income has been falling. Now, of course, not every single dollar of M2 gets spent on goods and services. That is true. And we'll look at that. We'll look at a slide that kind of gets into that particular point in a second. Some of it, yes, does go into assets. And we'll take a look at that later on. Here's personal income per capita as a share of the M2 money supply. And again, what good is a nominal increase in personal income, which is how the data is reported, if the money supply is growing faster, if inflation or real inflation is actually growing faster than the rate of personal income or your average hourly wage or things like that. So here's yet another way to kind of drive this point home. Here we're looking at the average hourly wage in gold terms, which, by the way, just set a new all-time low, lower even than the late 1970s when this got down to these sorts of levels, and of course the early 2010s when it was quite low as well. The average hourly wage in gold terms is now, you only, for 1 hour of work, you only get 0.01 ounces of gold on average. Now, just for comparison, back here, we can see that you would get about 0.06 ounces of gold for the average hour of work. So in gold terms, your wage has been devalued by 80%. Yeah, in dollar terms, your wage is probably going up and to the right. However, once you start to adjust in, again, different ways, whether you look at it as a share of GDP, whether you look at it as a share of the M2 money supply, whether you look at the average hourly wage in gold terms, no matter how you do it, it paints a very, very different picture from just the nominal figure. If you look at the average hourly wage, US wage in TradingView, that is up and to the right. Again, going back to personal income, it looks like this, and it looks like everything is great. However, again, the issue is not that the data is fraudulent or incorrect or that they're lying. The problem is, again, the way that the denominator that you are using, or the way, the lens through which you look at this data. That is really where the disconnect is. As an example, not only is the average hour of work getting you an all-time low in gold terms, again, gold generally over long periods of time is a good proxy for currency debasement or monetary the expansion of the monetary supply. If you look at total wages as a share of the M2 money supply, again, down and to the right, relentlessly back here in, say, the 1970s into the 1980s, this was about 85%. Well, if you look, it is only 44% today. So what that means is the total wages for every American all across the country, in real purchasing power terms, in M2 money supply terms, this is a direct measure of how many currency units are in the system. And again, those currency units chase goods and services and assets further up in terms of price. So we're looking at it directly. Well, in those terms, total wages have lost 50% of their purchasing power going back to the 1970s or the 1980s. Now, the per capita annual wage as a share of GDP, you're not going to, the per capita annual wage is going to be, call it $70,000, and GDP is $30 trillion. So over here on the axis, you're going to see zero. But the point is the direction of travel here. The per capita annual wage using that average hourly wage, which again in dollar terms is up and to the right, as we can see, it is keeping nowhere close with GDP. So again, what good is 3.8% GDP growth, which again It's not that the data is incorrect, it's the lens through which you look at the data. The fact that GDP itself is a flawed metric. How is GDP calculated? Well, debt fueled overconsumption, debt fueled consumer spending is a positive for GDP. What else is a positive? A wasteful, unproductive government spending is it gets recorded as a positive for GDP. But of course, it's not productive to spend $8 billion on a bunch of EV chargers and zero actually get built, or one or two actually get built, right? It's not productive spending. So the problem is with the formula itself and how the metric is actually calculated, not that the data is incorrect. The data is painting an accurate picture. The problem is what picture is it really painting? Because here we can see the average American has been getting just absolutely decimated. So if we go over here, why is there such a disconnect between, say, GDP data coming in very hot, which it did, 3.8%, very, very strong, such a disconnect between that and, say, consumer sentiment? If we go back to this, again, it's at levels that are lower than the 2008 great financial crisis. So what is going on? Same thing with the summary of current economic conditions index and index of consumer expectations. This is moving forward into the future. All of these are showing the same story. Well, again, those are reflecting the blue or the green line, right? They are not reflecting the data that the government reports, which is the white and the yellow line. They are reflecting the blue and the green line, or any of these three lines. That is what those sorts of metrics are reflecting. They're reflecting that the median American is just getting decimated in terms of the real purchasing power of their wage. Their wages are not keeping up with assets like home prices, like the stock market, like gold, and they are underperforming things like GDP. So again, it's not that 3.8% GDP is incorrect. The problem is that GDP itself is a flawed metric. You have to look, what good is a 3.8% GDP if your wages are only growing at 1%? Well, of course, that's what's been happening. So yeah, the data is accurate. The problem is not that the data is a lie. The problem is this. The problem is most of the mainstream outlets do not interpret the data accurately. Hopefully that makes sense. So going to kind of how we have a surge in in personal spending, personal income, like this K-shaped economy concept is really important for people to understand. So here we see the S&P 500 going all the way back to 1985. And then we see the average home price going back to 1985. As we can see, those that have assets have just wildly outperformed. Now, the problem is that those are outperforming the average hourly wage. So if we go here and look at, say, the S&P 500 in average hourly wage terms, we can see that back here in, say, the early 1980s, when my parents were coming of age and starting to work, starting to put money away and save, we can see that it took about 20 hours of work to buy one unit of the S&P 500. Well, what is it today? It is 210 hours. So what that means is that the S&P 500 has increased 10 times faster than the average hourly wage. So if you're a young person today, assets like home prices and the S&P 500 are running away from you. You don't have the benefit of capital appreciation from investing because, again, it takes 10 times the amount of real hours of work to get the same one unit of the S&P 500. It could be the average home as well. We know that the average home price is greatly outpacing the average hourly wage or the median family income for a given year. That is why home affordability is getting so bad, is the same exact concept that we're looking at here in blue, which is the financial asset is outperforming the wage, or whether it be the average hourly wage or the median family income, whatever metric you use, the financial asset is outperforming. But again, who holds all the financial assets? It is the top 10%. In fact, they own 93% of household U.S. equity exposure. And so as long as you have assets that are doing this, that are just melting up up, going vertical. Well, the top 10%, the wealth effect, which is they look at their brokerage, see a big number, and go out and spend money. That wealth effect will remain in effect. Now, if you are part of the bottom 80% of Americans, you don't have that wealth effect because you don't have financial assets. So, therefore, you are getting squeezed by, say, 3% inflation. And that is probably a low end estimate for inflation. Your wages have not kept up with GDP, they have not kept up with the M2 money supply. Your purchasing power is going down, as we can see from all of these metrics that we have been looking at. So, as long as the K shaped economy continues to grow more K shaped, we will probably see, a relatively strong personal spending, personal income, GDP, whatever metric you want to use in a K shaped economy. It doesn't really matter in GDP terms for the accuracy of GDP or the strength of GDP. It doesn't really matter that the bottom 80% have never felt worse. And we see that reflected by the survey responses that we see here with the University of Michigan. Unfortunately, it doesn't really matter because look at this. This is the net worth of the top 1% as a share of GDP. So again, remember what this means. If the net worth of the top 1% is growing faster than GDP, this line will go up. So this is, of course, in polar opposite to the per capita annual wage as a share of GDP, which we know has been underperforming GDP. Well, if you look at the net worth of the top 1%, that has been outperforming GDP, meaning it has been growing faster than the total aggregate US economic output. They have been doing better than GDP, and you have been doing worse than GDP. So this is that K-shaped economy. Of course, your line is down and to the right. Their line is up and to the right. Now, just for a hard metric here with the net worth of the top 1%, going back to 1990, if you totaled up all the net worth of the top 1%, it accounted for 81% of GDP. Now that number is 170%. So what that means is the net worth of the top 1% and GDP have both grown. The rate of change for the top 1%, the net worth change of the top 1%, that has grown 2 times faster than GDP. So, of course, both of them in just nominal terms are up and to the right. What matters is the relative rate of change. We know the average American, no matter how you slice it, is underperforming GDP. They're underperforming the M2 money supply. They're underperforming gold. But the net worth of the top 1%, that is outperforming GDP. So while you might be underperforming, they are outperforming. And again, as long as the stock market continues to melt up, they will have that wealth effect. They will be able to spend. They will be able to buy houses. They will be able to do all those things. It doesn't matter that someone like me, who's a young person trying to buy my first home and start a family and have the middle class American dream, it doesn't matter that I can't afford a house. It matters, but it doesn't matter for, say, GDP. It doesn't matter for the way that these economic data are constructed. And that is the fundamental flaw. Now, Canada has got a lot of issues, but one thing I will say that they have going for them, they have tried to construct a better KPI or key performance indicator than GDP. They have, questions to their people of, do you feel like you are in better financial health than you were a year ago? Do you have hope about the future? Do you feel safe in your neighborhood? Things like that are a real metric of real happiness, real success, real prosperity. They just started this like a year or two ago, but I give them credit. That is much more useful than something like GDP. What good is GDP when your wages are underperforming it? What good is GDP when your wages are underperforming the growth of the money supply and therefore the price of financial assets? As we can see, the S&P 500 has appreciated 10 times faster than the average hourly wage. It takes 10 times as much work to get the same 1 unit of the S&P 500. So anyways, hopefully that was helpful. Hopefully that helped to answer some of the disparity that we see between some of these data points that keep coming in strong versus how people actually feel. So hopefully that was helpful, and I'll catch you in the next one.